Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today, we are going to be analyzing Elf Beauty stock, ticker ELF. The stock was down about 20% yesterday, and it's been on a bigger decline before that, so we'll take a look at that here in a second. As always, this is not individual investing advice. This is just how I analyze stocks. So, Elf Beauty, they're a smaller beauty makeup company, $4 billion market cap now. It was $6 billion, I think, when I checked it a while back. So I'll start off. I am long this stock and even a little bit overweight it. And we first bought this in the Cyclical Investors Club on, I think it was April 10th, 2023. So almost 2 years ago. Let's see. Right about there, we'll call it. And it's down about 15% since then after doubling and then halving. Off the top here, let's see. Down probably about 70%, it looks like. So big upswing and big downswing. They just reported earnings on Thursday night. I'm recording this on Saturday. Let's see, February 8th. So what we see when we look at this, now this is, I'm going to do a time until payback analysis of the stock. Let's shorten this a little bit to more like right here. So once COVID started, they were growing earnings. They only went public a couple years before this. They were growing earnings like mid-teens. And then we have earnings kind of exploding higher. And they basically doubled 2 years in a row. So, and then now this year, I would say they're expected to be about flat or just barely positive. So they went from fast growth to slow or no growth this year. And it looks like analysts right now are projecting like low double digit growth the next couple of years. But that's still a question. So they've kind of run into some, it's hard to completely decipher what's happening right now, like, because there's a lot of different things. They import a lot of their stuff from China, their products from China. So tariffs are going to play a role if they get too high. Now, if it's just like a 10% tariff, like we're talking right now, I don't think that's like a big deal. They say they're going to wait and see where the tariffs level out at, and then see if they need to raise prices once they get an idea what they're actually going to be, which makes sense to me. It sounded like sales for January for their products were very slow, like slower than they expected, and they talked about that. So that news is why the stock is trading down. So the PE ratio right now is 21% after the decline. We also have the possibility that this was kind of a boom-bust situation. Everybody bought a bunch of makeup, going back to work, pandemic's over, you're getting back out in society a little bit more. That could have led to a boom. Now, most boom-bust companies were 2 years before this. So I don't think that's like exactly what's going on. They also have issues with TikTok because they do a lot of their marketing through online and TikTok. So that had some disruptions. Apparently, they say that LA wildfires did as well with some of the influencers there. I don't know how all that works out, but it's enough uncertainty that investors are selling the stock and shorters are definitely shorting it now. So we're back down to a PE below the S&P 500 now, and we still have the possibility for a lot of growth. Now, the way I think about this is really long term. These guys are a very small company in a very big industry. If you look at L'Oreal or Estee Lauder, they're leagues bigger still, even after Estee Lauder fell like 80% or something like that, 70-80%. It's still probably 7 times bigger than Elf, market cap wise. So there's tons of room for them to grow long term. They know how to market in this environment, even if they have to kind of adjust for TikTok or whatever happens there. I feel like that they'll be able to do that. Their products are cheap cheaper than almost everybody else's. And from the people that I've talked to, they're good. Like the products are good. So it's a good value. And so I think in a lot of the market are younger people. I mean, younger women, not always. I mean, my wife has like elf products, but I think that bodes well longer term if they hold those customers into the future, right? So that's why I like the stock long term. So just the general business and the whole setup. So then the question comes about valuation. Now, assuming we don't have like a recession, and that's the reason, sales slow, which is possible, even if it's just a recession in their demographic. You kind of see the same thing happen with Celsius holding stock too, where I think it's kind of like a younger person's drink. Maybe they don't have as much money to spend right now. And so that's one of the things that kind of gets cut back or makes it harder for the business to grow. I get a sense that could happen even if there's not just like a gigantic recession or something like that. So that's kind of the setup. So what I want to do is look at the valuation and see how long, if we bought this business, would it take for an investor to earn their money back from earnings. So if you bought the whole business for $100 or you bought a $100 piece of the business, how long would it take to for the business to earn $100 from earnings? So that's what we're going to do. If you watch my channel, I do this with a lot of stocks. So what this looks like is I'm going to do two different valuations here. One's going to assume a 20% growth rate. That's what I used back when I originally bought ELF. But the stock's low enough now, I'm also going to look at a 15% growth rate. That's probably more in line with what analysts are thinking the next couple years, which seems very reasonable to me, given how small they are, given how fast they've shown. I mean, one more year of like 50% growth, that can take a big chunk out of these long-term earnings growth expectations. So even if they have a year where earnings go down a little bit because there's all this stuff going on, I think the foundation's there where we could, once that year or two has passed, then they could just rock it up and make it all up in like the third year or something like that. So I think 20% growth is reasonable but optimistic, especially given where we are right now, since we can see earnings growth are flattening out. And 15% seems pretty conservative to me. So here's kind of what they look like. I should just pick one here, and if I can get my spreadsheet to move. Okay, so let's go back here. I'm just going to look at the 15% one and show you how it works. So the short answer is it would take 10 years to earn your money back just from earnings. If they grow at 15%, and it would take 9 years if they grow at 20%. So we have the earnings yield. They had net cash last time I checked, like a little bit. I didn't count any of that. I'm just using the straight up stock price, so I'm not making any debt or cash adjustments. So this is basically just straight up from the PE ratio. The earnings yield is the inverted PE ratio, so the earnings over the price, and that earnings yield is 4.67% right now. That means if you paid $100 for the business, the first year or without any growth, that $100 would earn $4.67, okay? And what I want to know is if that grows at 15% a year, if that $4.67 grows at 15% a year, how long would it take to earn an additional $100? So that's what the spreadsheet's set up to calculate. So it looks something like this. That first year, you get 15% growth, you earn $5.37, you keep that. The next year, you earn $6.17, you keep that, and then that money accumulates, and you want to get up to an additional $100. That would take about 10 years. It looks like about 9.5 on the spreadsheet. So for me, if you watch some of these, there aren't very many businesses right now where you could earn your money back in 10 years from earnings. Now we can look and see if you wanted to go lower with this at 10%. You would still earn your money back in 12 years. That's still way cheaper than the S&P 500. The S&P 500 is at 15 years right now. So even if you were even more conservative, as long as you're willing to wait kind of through the volatility, ELF makes a good buy. So here's kind of the framework that I'm using to explain this to people. Now, in the Cyclical Investors Club, and I have a weekly pick service too, and it's set up this way as well. So each position is a 0.5% weighted portfolio position. So if you have a $100,000 portfolio, that's about $500. And then if you really the standard weighting, that's the standard increment. The standard weighting is about 1%, and then an overweight can go up to 2%. And that's the maximum, right? In terms of starting weighting. Now, if you buy something and it grows to a bigger portion, I don't sell long-term holds, which is what ELF would be, because they grow. So it could, like I have AutoZone that I bought during the March 2020 decline. It's almost up 400%, so I haven't sold any of that to get it back down to 1%, to a 1% weighting. It just keeps becoming a bigger part, and it kind of earns its way. That's my approach. So I think what I would do with ELF here, because the momentum is horrible, the technicals are horrible. Like if you look at it, you have like a head and shoulders and then like a deep dive, right? And I think if they do have a rough year, the next 15 months, we'll call it, the stock price could definitely go lower. So I'm not calling a bottom in the stock price because the market just hates it so much. I don't know where it will bottom, and I don't even know how earnings are going to do over the next 12 to 15 months. But I think all the foundation is there for the long term, even if maybe earnings are negative next year and the stock falls lower, right? So the approach I would take is to take like a 0.5% weighted position based on the valuation right now, and then wait for momentum to improve, or maybe 9 months from now you can see that earnings are not falling off a cliff and they look solid and they're coming back. Get a little bit more clarity on the earnings direction. Chances are, if that happens, the stock price will bottom very quickly and the technicals will improve, and that would be when I would add like another 0.5% position. Now I've already added 3, so I took this initial 1% position a couple years ago, and then last fall I added another 0.5% position. So I could add one more position, and I'm waiting until those technicals improve before I consider adding. Or if I'm wrong and we go, I don't know, I would at least go like 2 years. And if we go a couple years and earnings just still suck and we're not like there's not an obvious explanation, like we're in a recession or something like that, if everything else is pretty good but things are still going down, then I wouldn't buy anymore, because the valuation wouldn't work the same way it would work now based on what I'm assuming, right? If next year's earnings are lower, that will lengthen the time it will take you to earn your money back from the earnings, right? Just like I showed you. So that's my thoughts on ELF. So I think it's like a buy for a starter position or to start easing in. I wouldn't go like all in on it here. And as a person bought it, I wouldn't say, oh, this is the bottom, right? I think it's probably going to take 2 or 3 years to see how it turns out. And then it would be just a long-term hold for me. So even if earnings fall, I'm not selling. I don't expect I'll be selling this even if things go bad for at least a couple years. So that is my approach for ELF. If you found this video useful, hit the like and subscribe button. I have a weekly picks service over on Patreon for $25 a month, and I share a stock pick every week over there. Even if I can't find anything that's great in the market, I find whatever the best thing I can find is for that week. And we take that, my assumption is taking that approach of 0.5% positions each week in something that I find with no more than 4 picks of the same stock. So no more than 2%. So just like I actually do it in real life, I don't necessarily dollar cost average like that in my positions, but I am long all the positions that I think are buys. So, all right, everybody, thanks for watching, and I'll see you later.